All right, let's dive into one of the biggest debates in the entire financial world. It's this epic clash between two totally different ways of looking at the market. You've got the fundamental analysts on one side. They're like the detectives, digging through a company's books. And on the other side, you have the technical analysts. They're more like artists, reading the patterns and the psychology hidden in price charts. Let's get right into it.
So I want to start with a big question right off the bat. Which one are you? Are you the kind of person who needs to know a company inside and out before you even think about investing? Or do you believe that that price chart tells you the whole story? Stick with me, and by the end of this, you'll probably have a much clearer idea.
Okay, so let's start with the core philosophies. I mean, both groups are trying to do the exact same thing, right? Make money. But the way they try to get there, their deep-seated beliefs about how the market actually works, well, they're just worlds apart. This is honestly my favorite way to think about it, and it makes so much sense. The fundamental analyst, they're using a microscope. They're zooming way, way in, looking at every single detail of a company's financial health. Then you've got the technical analyst, who's using a telescope, looking at the big, sweeping picture of market movements and price patterns from really far away. So let's grab that microscope first. Fundamental analysis is all about one thing: figuring out what a company is actually worth. We call this its intrinsic value. And to do that, analysts dig into, well, everything. They're looking at financial statements, the health of the overall economy, the industry it's in, all the fundamentals. The core idea here is that a stock's market price will eventually find its way back to its true value. Okay, now let's pick up the telescope. Technical analysis is, well, it's a completely different beast. Technicians really don't care about a company's earnings reports or who its CEO is. Nope. They're all about the stats, looking at past price movements, trading volume, that kind of stuff. And the key assumption here, that human psychology is pretty predictable. And because of that, historical price patterns tend to repeat themselves over and over again. So we've got the basic philosophies down. It's value versus patterns. Now let's really put them head to head. Let's see how these totally different worldviews lead to totally different ways of operating. This is where you can really see the divide. This slide right here, this gets to the absolute heart of the conflict. The fundamentalist is on a hunt for true value, working from the idea that the market price will eventually snap back to reality. The technician, on the other hand, is trying to forecast price movements, and they start with the belief that the current price already reflects everything there is to know. So one is trying to outsmart the market, while the other is just trying to ride its waves. And, this difference in what they believe leads to a massive difference in their timing. Fundamental analysis is the long game. It has to be. You find a company you think is a bargain, and then you just wait, sometimes for years, for the market to catch on. That's investing. Technical analysis, though, it's built for speed. It's all about finding opportunities over days, weeks, maybe a few months. That's trading. So what's in their toolkits? Well, the analyst is that financial detective, right? They've got their income statements, balance sheets, and cash flow reports. The technician is a pattern spotter. They're living in charts using tools like moving averages or looking for classic patterns like a head and shoulders formation, which might signal that a trend is about to reverse. It's all about what happened in the past to predict what's going to happen next. And if you want the poster child for a fundamental analyst, look no further than Warren Buffett, the Oracle of Omaha himself. His entire legendary strategy is built on this very foundation. Find fantastic companies that are just temporarily out of favor, buy them, and then just sit back and wait patiently for their true value to shine. Okay, so we get the what and the how. But those different time horizons we just talked about, investing for years versus trading for days, they introduce completely different kinds of risk. So let's tackle maybe the most practical question of all. How do you manage that risk? I mean, it's the question everyone wants to know, right? Is it riskier to bet on a company's long-term success or on a short-term wiggle in a chart? Well, the answer, it's not quite that simple. See, the key thing to understand is that risk is relative. A short-term trader, they're exposed to all the daily noise and volatility. A single bad headline can totally wreck their position. A long-term investor, though, their risk is different. It's fundamental business risk. What if that company you thought was a bargain never actually recovers? Your timeline really defines your risk.
So, how do the pros try to systematize this? Well, one famous tool is called the Kelly criterion. It's this pretty complex mathematical formula that basically helps you figure out the optimal size for a bet. It weighs your probability of winning against how much you could win, all to help you maximize your growth over the long haul. It's a way to turn risk management from a gut feeling into a science.
Now, you're probably not going to pull out a calculator for every single trade. It's a lot. So, a lot of professional traders boil this whole principle down to one simple golden rule: never risk more than 1 to 2% of your total capital on any single trade. It's a circuit breaker. It makes sure that one bad call can't knock you out of the game for good. But here's the thing: even with the best risk management rules in the world, there's an even bigger threat out there. It turns out the greatest risk isn't hiding in the charts or the balance sheets. It's right between your ears. Mastering your own mind is absolutely everything. So meet the two great destroyers of trading accounts: fear and greed. Fear is what makes you panic and sell a winning trade way too soon, leaving a ton of money on the table. And then there's greed. It usually shows up after a few wins, makes you feel invincible, and convinces you to take some massive, reckless risk that, let's be honest, almost always blows up in your face. And these emotions show up in some really predictable ways. Does any of this sound familiar? Loss aversion. It's been proven that the pain of a loss feels way stronger than the joy of a gain. FOMO, the fear of missing out, so you chase a skyrocketing stock and buy at the absolute top. Overconfidence. You hit a few winners and suddenly you think you can't lose. And maybe the most dangerous of all, revenge trading, where you try to instantly make back the money you just lost. It almost never, ever works. So how do you fight your own brain? Okay, here are 3 concrete things you can do. 1, before you even click buy, just accept that this trade could lose. Seriously, mentally accept it. It takes away the emotional sting. 2, use a 3-strike rule. 3 losses in a row, you're done. Shut it down for the day, go for a walk. And 3, focus on your execution, not your P&L. Trade the setup, not the money. If you followed your plan, that's a win, regardless of the outcome. This quote from the legendary trading psychologist Mark Douglas just says it all, doesn't it? The real edge in the market isn't some secret indicator. It's having unshakable discipline that you build through mental preparation. Okay, so we've laid out these 2 very different, opposing views. But what if the real answer isn't about picking a side? What if the smartest thing to do is to actually use both? This is where this really cool, kind of newer idea called the adaptive market hypothesis comes into play. It basically argues that the market isn't some fixed mechanical system. It's much more like a biological ecosystem. It's constantly changing, adapting, and evolving based on who's participating at any given time. And the implications of this are huge. It means that no single strategy, not fundamental, not technical, not anything, is going to work all the time. The relationship between risk and reward is always shifting. So the key to survival isn't a rigid belief in one system. It's flexibility. It's the ability to adapt. Maybe you use fundamental analysis to figure out what to buy and technical analysis to figure out when to buy it. Which brings us to our final thought. Maybe this whole debate, fundamental versus technical analysis, is just the wrong debate to be having. Instead of asking which one is right, maybe the much more powerful question for any of us is this: which lens are you going to look through first to build your strategy and adapt to a market that is always, always changing?